The Japanese yen continues to struggle against a backdrop of unresolved geopolitical tensions, according to a new report from Commerzbank. Despite verbal signals from Japanese authorities and some signs of resilience in recent weeks, the yen has yet to see a meaningful recovery. The root of the problem lies in the ongoing conflict overhang, particularly in the Middle East and Eastern Europe, where uncertainty remains high. Investors, still wary of volatility, are opting for safer assets like the US dollar and Swiss franc instead of the yen. This has kept the yen under pressure and limited its ability to appreciate. The Commerzbank analysis highlights that while the Bank of Japan has signaled tighter policy in recent months, the broader geopolitical environment is drowning out those signals. The market is watching closely for any hawkish shift from Tokyo, but for now, the yen remains vulnerable to risk-off sentiment. The report also points out that Japan's monetary policy divergence from its major trading partners continues to weigh on the currency. While other central banks have moved toward normalization, Japan has been slower to follow, creating a mismatch in expectations. This divergence has kept most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The yen weaker than it might otherwise be, even as global markets occasionally test its resilience. The USD-JPY pair has remained elevated, and Commerzbank warns that this trend may continue unless there is a de-escalation in global tensions. The pair is currently testing key resistance levels, and traders should be prepared for further volatility. The yen's recovery is being held back not just by policy, but by the broader risk environment. In a world where even minor geopolitical shifts can trigger market moves, the yen's role as a traditional safe haven currency is being challenged. Investors are increasingly skeptical of Japan's ability to influence the situation through verbal intervention alone. The Bank of Japan has made statements and hinted at possible action, but without coordinated global support, those signals have not translated into meaningful movement in the yen. For now, the market is waiting for more clarity. Traders and businesses dealing in yen cross rates should be aware of the potential for sudden spikes if tensions escalate further. The report suggests that while the yen may show occasional strength, a sustained recovery is unlikely until the geopolitical overhang is resolved. This means that USD-JPY could remain a focal point for forex traders in the near term. The next key signal to watch will be whether Japan's central bank takes more decisive steps to stabilize the yen, or if the global risk environment shifts in a way that makes the yen more attractive again. Until then, the yen's path remains uncertain, and the broader market will likely continue to favor stability over exposure. The stakes for traders and import-export businesses are high, as the yen's volatility affects trade balances, investment flows, and hedging strategies. A sudden move. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The yen could disrupt these operations, especially if geopolitical events trigger a sharp shift in market sentiment. The mechanism at play is the interplay between risk appetite and central bank policy. As long as global uncertainty persists, the yen will remain on the defensive, with USD-JPY likely to remain elevated. The next signal to watch for is a potential shift in the geopolitical landscape or a more aggressive policy pivot from the Bank of Japan. Until then, the yen's recovery remains on hold, caught between the forces of global risk and domestic policy inertia.